So how do real estate partnerships really work? Real estate partnerships can multiply your buying power or it can destroy relationships. Let's break down how to structure one the right way. You want to invest in real estate but don't want to do it alone? Partnerships can definitely help, but only if you understand actually how they work. How do you truly grow and scale your real estate investments? Well, it is partnerships. I've seen the biggest investors in the world, they run low on capital because real estate is a capital-intense industry. By the end of this video, you're going to understand how partnerships work, how to structure them, and how to avoid the biggest mistakes when you do start teaming up with new partners in real estate investing. All right, so what's a real estate partnership? A real estate partnership is when two or more people or entities invest together in a deal or portfolio. So we're talking about pooling resources with the ability to find a deal, to get debt, to get access capital, to operate a piece of real estate, to improve construction, and then to account for all the reporting and all the different financial aspects of it. We're looking for who has the capital, the credit, and the expertise. And then in turn, we share in the profits, in the losses, and the responsibilities. So there's a bunch of legal ways that you can structure a partnership. It can be done informally, which is known as a general partnership, which would be a glorified sole proprietorship with very little paperwork involved. Or it can be formally done where I prefer a limited liability company partnership. Before you even start, though, the key is aligning in the roles, the expectations, and then having written agreements. All right, well, in every real estate partnership, there's two key players. You have limited partners and general partners. So a limited partner is typically the capital partner, the partner that's putting up the actual cash. They're normally passive and they are not operating or actively managing the property or the business. Limited partners will usually expect some type of preferred return, either an interest rate on their capital invested. At my company, Patriot, our investors get an 8% preferred return before they start getting their capital repaid. But the preferred structure is flexible and can be structured in any way the partnership decides. Another way to structure a preferred partnership is every dollar of profit that comes in goes to pay back investors first before the general partner gets paid any profits. And that leads to the second role in the partnership, and that's the general partner. General partners, typically the visionary or the one that starts the investment. They're going to find the investment. They're going to get the debt for the investment. They're going to operate the investment. They're going to report on the investment. They're going to improve the investment. The general partner is responsible for all the day-to-day activities, and they're responsible for the key decisions that are made on the investment. General partners may put in capital or they may not. And general partners will earn profits by managing the assets either through fees or through performance or both. Meaning after a certain amount of profits are hit for the limited partners, the general partners now get to participate and get a piece of the profit after the investors have been paid their capital. We call this a GP and LP structure, general partner, limited partner, partnership structure. And in real estate, what's most customary is a limited liability company. This is very similar to the traditional private equity structure. So how are profits split? This is a critical question every partnership has to address up front. And this is where the relationship between the general partners and limited partners gets clarified. And how the profits are split are in an operating agreement. A common model is the limited partners get the preferred return first. Then they get a return of capital. So a common model is structured like this. It's called a waterfall structure. This is as the buckets of profits start coming in from a real estate investment, then there's an order of return that is distributed to the partners. So the first waterfall is going to be the preferred return. That's the money or interest calculated on the initial investment that an investor made on their capital account. So if it's an 8% preferred return, the first 8% of profits goes to the investor. Next is there's a return of capital waterfall. And this can be structured any way you want in a real estate partnership, but this is how I structure most of my partnerships. So after the 8%, the investor starts getting their investment repaid back. And then after the investor has been paid in full, there's a split between profits. And in Patriot, we pay our investors or our LPs 70% of the profits and 30% go to us as the general partners. And now they've achieved a 12 or 13 or 15% return, and we start participating in profits above that. After a 15% return on the investment, then it splits 50-50 with the investment partner and the general partner. In the end, we buy a real estate property, it cash flows, they get that cash flow. Any additional cash flow, it starts repaying their capital account or their investment. And then when we sell or refinance the asset and get a large capital event, that's when us as the general partners get to participate in the profits that we created. And we get that 30% and then 50% above a 15% average annual return to the investor. This is where there's an alignment of interests, where the investor essentially has to make a 15% return before the general partner starts really participating and making a heavy profit off of all the energy they invested in creating that investment opportunity. So how are decisions made? Well, this is outlined in the operating agreement. This is the Bible of the partnership. And the GP, or managing member, in an LLC, it's actually called a managing member, but it's jargon that's the GP role. And then the limited partners are the members. They're the passive members. Well, the managing member, GP, they have the majority of decision-making capabilities in most partnerships. So unless they act egregiously and they're not acting on the best behalf of the unit holders or the capital investors, the LPs, then they have the full right to go make the decisions. They're going to buy the assets that they decide to buy. They're going to operate and manage the way they see fit, and they're going to sell the asset when they feel they've maximized value. So as a limited partner, you're trusting in the GP to make the right decisions. In the operating agreement, there's going to be dispute resolution provisions where if there are disagreements between either limited partner or general partner, or between general partners themselves, if multiple members or managers are in the partnership, that's where that's going to be outlined, of buyout provisions, of bad actor behavior, or a need for liquidity if someone wants to exit the partnership early. So what are the key documents that govern these partnerships? Number one, an operating agreement or partnership agreement. I highly suggest an LLC. This is the best real estate multi-member partnership legal structure. In there is going to be a capital contribution schedule. How much are people investing in return for how much ownership they're going to get? This will also outline what happens when there's a capital call. If the investment is insolvent and there's a capital need, this will outline what happens when there's more money that needs to go into the partnership. Is it upon the GP to put up that money or lend that money back to the partnership? Or is there a capital call to all members and general partners for their pro rata share of ownership to pony up more capital in order to make the investment solvent again, in order to recapitalize the investment? And if that capital call is not met, what happens to each member's shares? Is a member's ownership interest diluted at that point, and other members would put up their capital call for them and get some of those ownership units in return for that? A key point in the document is exit strategy and buy-sell clauses. How long is the life of the investment? If it's 5 years, then the asset will be sold in 5 years. If there's a buy-sell provision, if someone needs to sell their portion of units, how is that valued? What is the timeline? And what are the terms around that exit or buyout provision without jeopardizing the success or the health of the financial position of the investment? If one partner wants to get paid out right away, but there's not enough cash in the partnership can't just liquidate assets or draw on all the operating reserves in the accounts, because it could jeopardize the entire company or the real estate partnership. Roles, rights, and responsibilities. Who is responsible for managing and making the right decisions? And then if they are responsible for it, how do they get paid? What are the property management fees, asset management fees, reporting fees? This is outlined up front in the operating agreement. Profit distribution rules. This is what we talked about with the waterfall schedule. How are profits paid? Tax treatment and reporting expectations. Who will be receiving the losses? Are they pro rata amongst the owners, or is the limited partners getting all the passive losses? And what are the reporting requirements? Is the manager or GP required to give quarterly financials, to give asset updates, to disclose if they're putting new debt on the asset or considering selling? These are all outlined in the operating agreement. So what makes a real estate partnership work long-term? So do this. Set clear roles early. Use formal legal agreements. Align the incentives with everyone that's in the partnership. Plan for the exit up front. And communicate regularly. What doesn't work? Making assumptions but not having an agreement. Handshake deals only. It's only real in real estate if it's in writing. Flat 50-50 splits without unequal effort or without a decision maker. No exit strategy in writing, and lack of communication, especially around tax season. The best partnerships are built on trust and structure, where you have an expectation and then you have all partners agree on the expectation. So now you know the keys to a successful real estate partnership. So before you go into another partnership, make sure all these things are handled. And in this next video, we want to go over what are some of the best opportunities in commercial real estate investing. That way, when you find that opportunity, you know exactly how to structure your partnership or invest passively into that partnership. So you have the highest chance of success. And that way you can play the long game, win the long game, and play it with long-term partners. Thanks.